Ladies and gentlemen, first of all, I'd like to thank Stefania and Cassiopeia for organizing this event and for inviting me. It's always great to speak to seasoned investors about our favorite topic. And I'd just like to focus on gold for 5-10 minutes because even though I am involved in oil, let's not confuse the two subjects because they are quite distinct and separate at the moment in what are the driving forces behind them. I have to say that I might be a little bit biased because I've been investing in gold mining companies since 2003, and I run Junior Gold that invests in gold and silver mining shares. So I have been a long-term bull in favor of precious metals. But many people ask today, what is it that has caught investors' attention, and why is gold suddenly, in the space of 4 to 5 months, shot up to $1,500 an ounce, a level that has only been seen 6 years ago? And most of us who are involved in the industry have endured a vicious bear market for many years where nothing basically would move gold. There have been so many geopolitical events. We've had Russia invading Crimea. We've had the Syrian conflict, and nothing seemed to move gold. Yet suddenly, in the last 4 or 5 months, gold seems to be flying and being, the investor's darling. Geopolitics might be one big driving factor. I think we all agree to that the situation in the Middle East in particular has worsened significantly. So investors are being much more risk-averse and cautious in their portfolio allocation. And gold has traditionally been one of the favored safe haven investments and portfolio diversifiers since antiquity. So people naturally buy into gold. But in my view, I think there are two major driving forces that could signal the beginning of a multi-year bull market for gold. And that is, first of all, the macroeconomic uncertainty. We see signals that there might be some recessionary forces at work. We have seen a slowdown in the Chinese economy that has been the driver of world growth for many years now. We have seen even the US economy faltering lately and the manufacturing indices weakening. Whether that is attributable to the trade wars that the US administration has started, or it is the natural evolution of the economic cycle, that's something to be debated. For certain, the trade conflicts and the trade wars, whether it is between America and China or within the Eurozone, have a big role to play in making investors more cautious about their capital investment decisions. And therefore, that is a break to economic growth. But most importantly, I think the third driving factor for gold is the recent change in policy by major central banks, and most importantly, the US Federal Reserve. We have seen a radical departure from previous narrative and a hawkish tone in previous years, tending to raise interest rates, to a sudden change in policy and an actual cut in interest rates. So we now have in the world approximately $17 trillion of government debt that is negative yielding. So effectively, investors holding that debt are paying the governments to hold that security. And that is a major driver for gold, because hitherto gold has been seen as an asset that not only does not pay any interest, but actually costs money in terms of storage and safekeeping. So these are the three major drivers which, in my view, are unlikely to change in the very near future. And given the relatively narrow market of gold, we have seen investors flocking in bullion. And the natural evolution would be to look at the impact the rise in the gold bullion price is having on the mining companies. Over the last 9 to 12 months, we have seen the major producers and the mid-cap producing companies outperform the general gold precious metals equities. At the moment, we are seeing a little bit of consolidation as gold trades around $1,500 on an ounce. But in my view, the next step for investors would be to look at smaller companies that are the growth engines of the industry. These are the companies that hold prospective assets, that have either discovered or are drilling to enhance their resources and increase the value of their deposits. And they will not be only an addition to their value because of the appreciation in the bullion price, but also because the larger companies will be looking to beef up their production life cycle for the next few years, and therefore we expect to be some significant corporate activity in the sector. So with these few words, I think it makes sense for any well-diversified portfolio to have a strong allocation to precious metals at the present time, with some of it being in bullion, some of it in the senior and mid-cap producers, and some in the smaller producers that are the growth engines of the industry. And with that, I wish you happy investing.